$21,692. That's the exact capital the IRS extracts from a non-American holding SPY for 20 years. You don't see it, you don't feel it, and that's precisely how it was designed. On a $100,000 portfolio, that's over 21% of your starting capital. Gone. Not a fee, not a tax bill you sign, a 30% slice taken before the dividend reaches your account. The IRS isn't a government here. It's an inefficient line of code buried in your holdings. Every quarter it executes. Every year it compounds the damage. Non-US investors think they're buying America. The structure disagrees. The math is indifferent. 30% US withholding versus 15% Irish domiciled. Same S&P 500 exposure. Half the structural bleed. Institutions have known this for years. They don't buy SPY. I'll show you exactly how to cut that number in half before the next dividend hits. Let me make that real. You wire $100,000 and buy SPY. On paper, everything is right. Then the first dividend lands. You expect $1,500. You see $1,050. The broker doesn't explain. The missing $450 is already routed to the U.S. Treasury. Every quarter, around $270 vanishes before you click reinvest. $270 doesn't feel like much, but it's not a fee, it's a compounding leak. I ran the numbers. $100,000 in SPY, dividends reinvested, 7% annual growth. After 20 years, the account with the 30% drag sits $21,692 lower. Same market, same S&P 500. One line of tax code. $21,692 is a new car. A year of rent in central Lisbon. 22% of your initial capital silently erased. The IRS views you as a non-resident. The default rate is exactly 30%. No loophole, no negotiation. An automatic toll booth on every U.S. source dividend. You don't have to stay on that road. A parallel lane exists. Same destination, half the toll. Let me decode the mechanism. SPY is a US-domiciled fund. When it pays dividends, the source is American. For non-Americans, the IRS withholds tax. Without a treaty, that's 30%. You might file a W-8BEN and get a 15% treaty rate, but you're still leaking more than you need to. Here's the key. Ireland-domiciled ETFs hold the exact same US stocks, the same Apple, the same Microsoft. Ireland's tax treaty with the US means the fund itself pays only 15% internally. Then, Ireland imposes no further withholding on you. So a non-American holding an Irish UCITS ETF faces just 15% total US tax leakage. Not 30%, not 15%, plus another layer. 15. Flat. So re-anchor here. You are not being taxed on profits. You're being taxed before the money reaches you. That's not policy. That's a design flaw in your portfolio. Run the same $100,000, same growth assumptions, but with 15% withholding instead of 30%. After 20 years, the gap between those two paths is exactly $21,692. That's the cost of the 30% toll booth. Let me show you how the smart money drives around it. Open Interactive Brokers. Type CSPX in the search bar. iShares Core S&P 500 UCITS ETF. Domiciled in Ireland. Accumulating. Traded in US dollars on the London Stock Exchange. Expense ratio, 0.07%. SPY is 0.09%. You're actually paying less for the same exposure. Buy CSPX instead of SPY. From that moment, the IRS takes 15% inside the fund, and that's the end of it. For global diversification, use VWRA, FTSE All World, also Irish, also accumulating. Same mechanism. One ticker. The whole world. Accumulating means no dividends paid to you directly. They reinvest automatically. No manual reinvestment, no cash drag, and often no taxable event in your home country until you sell. Cleaner, cheaper, and it halves the structural bleed. This isn't sophisticated. It's not a loophole reserved for institutions. It's the same ETF structure, just domiciled in a smarter jurisdiction. One switch, one ticker change. Over 2 decades, you keep an extra $21,692. That's the quiet operator's move. But there's another hidden cost. Most ETF investors never account for. It's not a dividend tax, it's a tax on existing. The U.S. estate tax hits non-residents holding US-domiciled assets. The exemption is $60,000. Above that, rates climb to 40%. If something happens to you, the IRS can claim nearly half your portfolio before your heirs see a dollar. Next time, I'll show you exactly how to protect your estate with one structural shift. Do you know if your portfolio is exposed?